All right, folks. So we're going to go ahead and get started here. Thank you so much for joining us today. Today's session is going to be with our friend Avi Eyal from Entrée Capital. And my name is Ryan Burns. I'm the VC community manager here at Aurora, part of Innovation Bay, which is the largest VC community here in Australia, as well as Oceania. And we're really thrilled to have Avi with us today. It's one of those sessions that's a very special type of treat for us because we don't have too much experience in welcoming these world-class investors to our shores. So we're using the virtual component of everywhere to make sure. You want to help me? Mike's gonna let some people in. Got a lot of people in the waiting room. But yeah, let's go ahead and get started. Let's talk about what is Aurora, just to kind of introduce everyone to what it is. Aurora is a community of GPs throughout Australia and New Zealand. We host a series of dinners, lunches, programs, events like today at Google, or even our large-scale events like Venture Down Under, which is happening in August in Western Australia. We also host a variety of founder functions for our founder communities, which are typically for Series A or above founders located again throughout Australia. My name is Ryan. I'm from the United States originally. Grew up in Southern California and eventually made my way into San Francisco and New York. Worked at First Round Capital, which is a seed stage investment firm. Very, very active investor in a variety of things, but mostly SaaS products, and some well-known investments are Uber, or Roblox, Square, and a few other dozen unicorns. And learned a lot about personal relationships in the VC community and how we can all work together, not just as investors, but as a community itself to propel founders and our ecosystem forward. So today's conversation is going to be with a fantastic investor, one of the best in the world, in my opinion, Avi Eyal from Entrée Capital. He's early backer of Monday.com, Stripe, Coupang, Deliveroo, Snap, and PillPack. 15 plus unicorns, over $1 billion in under management currently, or maybe $1.25 billion. And really known for speed, conviction, and a founder-first approach. Today's format is going to be about a 25-30-minute fireside kind of chats, and then we'll leave about 15-20 minutes open for Q&A. We'd like to drop any questions that you have into the chat box. So we have some folks here in the room that I'd like to invite up as well if you'd like to ask any questions. But first, I'd like to say hello to Avi. Thanks so much for joining us. Are you located? It's very early where you are, and so we really do appreciate you joining us. Thank you so much. Let's dive in, Avi.
Thank you. Thanks for having me this morning, or this afternoon in your case.
Yes. All right. First off, let's talk about Entrée Capital and your journey as a founder and an investor. I guess the big question a lot of folks ask, when they meet an investor for the first time, and I've asked this myself, is how do you go from being a founder into being an investor? I guess the big question is the why behind starting Entrée Capital. I've read some things, but I really would love to know how that early vision evolved for you.
Yeah. So again, thank you for having me today. So I'm Israeli by birth, and moved to South Africa when I was very young. My parents whisked me away. Grew up in South Africa, studied computer and software engineering, and hence my technology background. And very early on, to pay my way through university, I started my first company, technology company, which I eventually IPO'd in South Africa and London. And after another 2 companies, I decided to leave South Africa, went to the States, started another couple of companies over the next decade, managed to sell them successfully, went to London, met my partner, who I know from the age of 6, from grade 1 in South Africa. We did one more business together, and at the end of it, we had established a fair amount of a balance sheet for ourselves, and we decided that we'd wanted to, what we thought was a change of pace, and start investing in companies. And the first step, what we did is to start investing in some VCs to get a much better network going. early stage VCs mostly. And with that, we started to seeing deal flow. That was about 15 years ago. From that, things grew, and one thing evolved into the next, and we started using our own capital naturally. And at some stage, we said there were a lot of folks asking us to come into deals with us, and we eventually decided to build Entrée into a business. Being serial entrepreneurs, we saw Entrée Capital as just another business that we were going to build. And it's probably the business I've stuck with the longest. So we've been going for 15 years, and so far so good.
Yeah, I would definitely say definitely good, considering all the wins you've had. Is, what is that core ingredient I guess you're finding in that consistency in your portfolio company's success? What is there something that you can find in the founders or in the type of investment that you are just finding these great wins?
So a couple of things. One is, the harder you work, the luckier you get. I think the quality of deals and deal flow that you have is proportional to the relationships that you have in the VC ecosystem and in the founder ecosystem. So references play a part, and by having good relationships with a few key VCs and establishing long-term relationships, we found that that's been a great funnel for us, an opportunity set for us. I think that in our case, being founders and being also technical has given us, or certainly in the first 15 years, gave us a real advantage. We were also working in most of our successes were in markets where people valued the experience that we brought, experience in markets across Europe, across the US. So I think a combination of things and a fair amount of luck really got us to the point of being pretty lucky along the way. And I think we've had more than our fair share of successes over the years.
Yeah, I'd agree. And you mentioned the harder you work. What goes into that hard work? Is it just reviewing the number of deals and doing diligence in a certain aspect, or is there a decision-making process that is more intricate and more detailed than maybe others do?
So I think everyone has their own style of work. We just come from I would say an old school of a way of doing things. We were brought up in a world where technology wasn't the main crux of businesses, in South Africa and elsewhere. And so we learned, I suppose, to evaluate businesses far more on numbers, on process, on things like that. And we learned how to build businesses in that world. And so when it comes to technology companies, I think a fair amount of folks get carried away with the hype around a founder, hype around the technology, or things like that. And we kind of more fundamental players in that approach. And maybe one LP of ours said to us, they evaluated our returns, and they said, the weird thing about Entrée is that you have top 5th percentile VC returns, but you have typical PE losses, not VC losses. And so I think that maybe there's a level of conservatism. So sometimes we miss the biggest hype in the space, but we also miss out the false positives at the bottom. So I think everyone has their own style. Ours is move fast, really understand the business, understand what's being built. A lot of focus on the founder, not in terms of their social network or how cool they are or things like that, but actually understanding that founder can build a big business, and the founder has the key requirements of being a good manager as well, not just a dreamer.
Yeah, I'd agree. There's a certain aspects we look as for a founder, but eventually those different aspects of what a CEO is maybe are different in what you evaluate. You did mention moving fast. Is there any type of timeline that you folks have at Entrée for deal flow, from maybe the first time you see something to a decision being made? We find that here in Australia, at least from my experience back in the States, deals are a little bit slower, in my opinion, out here. And that may be because of some factors that are on the VC side, but I'd love to hear from your perspective, what is the typical timeline on a deal for you folks?
So I think that it's hard to give you a clear number, but I can tell you that moving fast is not a negative and moving slow is not a negative. I really think it depends on the nature of the business that you're looking at and the nature of the opportunity. I do find historically, when I've looked at businesses in Australia, the timeline is much longer compared to a place like Israel, for example, or the Valley. But having said that, I think it's important that you really understand what you're trying to achieve, what the business is trying to achieve. The way we approach a deal is we typically like to ask someone to send us a deck or something first. We'll spend a bit of time understanding the market, understanding the business, understanding the opportunity. So by the time we meet the founder, it's a far more practical conversation than you send me the deck, okay, fine, and and I'll leave it and I'll read it 5 minutes before the discussion. Having said that, we've done deals where I've met folks and I've shaken their hand and the deal's done on the spot. And I've had situations where we've looked at a business over 3 years and kept coming back to it until we felt the timing was right. And so we didn't do the pre-seed or the seed, but we ended up doing the A. But we felt that there were certain milestones the business had to achieve, or fundamental legislation or things like that in the market in order for us to write a check. So really just depends on understanding where you are in the process, understanding that you're driven by the things that are important to you, not the speed of the deal.
Excellent. And in terms of those decisions, I've read a little bit about the framework that you folks call the 4 T's. I would love if you could kind of unpack that a bit for us to explain what those 4 T's are.
Yeah, so what we try to do is, it's very difficult to be formulaic in this world. But what we try to do is we try to put down in writing some of our thoughts, so we could educate our associate principals, future partners in trying to educate them on a better method to think. And so we came up with this thing called the 4 T's, which is timing, team, technology, and TAM. And the formula kind of goes timing multiplied by technology and TAM, all of that to the power of team. So kind of the weighting is such that the team is critically important, followed by the timing, and then technology and TAM make a difference and are important aspects to consider, and are not necessary conditions to consider. But certainly what we found over the years is that the team is so much more important to get right. And it doesn't mean that you have to invest in the perfect team up front, but it means that you have to set the expectation from the team up front of understanding what they're missing, for example, and understanding you are investing, but it's on the basis that when they get to Series A, they'll recruit a CEO or they'll recruit a CFO or et cetera, et cetera. So trying to be upfront and clear and transparent with the founders, around that how you build that right team for the business to succeed.
Yeah, that's great. In terms of that relationship, those I guess expectations or milestones that you do set with that team in the beginning, how would you describe that conversation being? Is it kind of collaborative? Is it more directive? Is it more, this is a check, but you're going to need to do A, B, and C when we get to that next level? How would you describe that if you had to, elaborate on it?
It depends on which key you're optimizing for at what point. But we've done deals where we've given them milestone checks. We've said, here's $2.5 million, but you're getting it in $500,000 chunks. And the first $500,000 is you get up front. The second $500,000 is when, for example, in a deep tech startup where you prove the fundamental science. The third check will be when you show us that the legislation, is right, or the legislation gets approved for what you're trying to build. So many times we've done milestone-based checks like that. When it comes to team, we kind of set the expectation up front of what we feel is required to be done. At times we won't invest if the founding team won't agree, or we don't see that there's an openness to approach it that way. In one or two cases, we've actually written a term sheet where the conditions in the term sheet is that this is the founding team, but it will recruit A, C, X, O, whatever, at the point where it's about to raise the Series A or post the Series A, etc. And we've made it a condition. And it's tough to enforce it because the reality of life is difficult, but I think it kind of sets the expectation, and it sets up front what a company can expect from us and what we can expect from the company. So it's harder to get it done every time, but I think that in our business it just kind of has worked much better for us over looking back over 15 years, where we set expectations up front. And everyone has therefore been, on page on what they're going to achieve.
Yeah, this first section is a little bit more about the deal decisions and that framework. But before we get into the next, which is kind of supporting our portfolio companies, I'd like to just dive into, is there any major things that you see right now in deals that you maybe would love to share with the Australian community that is something either insightful or interesting or different that perhaps is in your field of vision?
Yeah, so I think that a couple of things we're seeing, like kind of when we look at it globally, because we have folks in the US, UK, and Israel. So one is we're seeing that pre-seed, small angel type checks, everything up to 250 or 500K there's a big market for it, and things can move very quickly there. We're finding that for great business, good businesses and great businesses, seed has somewhat slowed down in many respects. Also, I think that the ability of, in this AI world, to build things and bootstrap things for longer kind of increases the valuation, which is great for founders, not great for VCs, early stage VCs, because if they're going to do a deal, it's at a much higher value, yet it's not clear that the outcomes are going to be at that high value down the line. And we see a lot of the multi-stage funds coming into seed territory writing checks because it's optionality. You can imagine you've got a 80 or 100 million seed fund. For you to write a 250K check is the same as a Sequoia and Andreessen writing a $5 or $10 million check. And so for them, it's, they're writing checks on optionality. And that's kind of mudding the waters a bit because they don't bring the same value to those businesses at that critical point in time. And so I think that there's still, for early stage VCs, I think there's still an artisanal play to be had, but it is artisanal. And so I think the pace of deals, the number of deals you do is slowing down or is slow. But I don't think that necessarily is a bad thing, because I think that's where a lot of the value can be added over time. I think what we're seeing is that the IPO window is starting to open in the US. It's going to be an interesting second half. Figma will IPO. My sense is if Figma has a good IPO, Canva will probably want to IPO, and a few others. Stripe will probably go out, if everything goes well, early next year. So I think that the market will go into one of these bull IPO markets, which is wonderful, because it means that a rising sea lifts all ships, and so the M&A market will unlock, and VC fundraisings will unlock. Right now it's very difficult to raise a new fund. Endowments have no money because of the federal challenges and lack of DPI. Pension funds have no money because of withdrawals and things like that, and DPI, lack of DPI. So I think that it's critical that the IPO window opens. And it'll be interesting to see the valuations at the IPO. I think the valuations won't be crazy initially, but I think those companies, as once they IPO, will grow very quickly because of the pent-up demand for liquid stocks. But the IPOs themselves won't be too ridiculously priced at this point. But I think everyone's getting ready, and I think we're going to look into the next 2-3 years of a very much of a bull market for VCs.
Excellent. Well, we all love to hear that. That sounds like I would totally agree that the net effects is wonderful to see. I was at First Round Capital when we had the Uber IPO, so I saw it personally, what can happen and what will happen. Speaking of those crazy valuations that you mentioned, back in 2021 to 2022, it was quite a wild time. And a lot of those, maybe even a third of those startups, have not hit their next round. I would love to hear from your perspective, how are you coaching founders through that environment, where bridge rounds, lower valuations, or even resets might be the path to long-term success? And what are the practical, functional steps you're taking with them? And I guess maybe on a lesser extent, how do you approach those conversations in a way that is supportive to founders, but is stark in reality?
Yeah. So I think our reputation is such that we don't pander to founders, and so we've always been very much business first, and trying to be practical. And in some cases that works for us, and others, it doesn't. But we are, as I said right at the beginning, for a VC, we're conservative, and we just have a fair amount of history and experience that we can leverage and we can see. So, pattern recognition makes a difference. We've lived through, certainly in the South African market, the recession days of the early 90s. Then I lived through the tech bubble in 99, 2000, then again in 2008. So you see a couple of typical things that happen. And so in 21, around June 21, I became very negative on the market. And then what I told all our startups to do was that they had 6 months to fix their business or to raise money, and to raise money on the bull case 2 year, 2 years of funding and go out again, but actually put in their drawer a plan for 4 years for that round. And most of our startups actually did do that. So we'll see what happens with the startups now that the 2 years are over of the lean times. But the same thing applies here and now as well. We think that you still build businesses on fundamental principles and don't get carried away. You always look at this funding round as your last funding round, because you don't know where the world will be in 2 or 3 years' time. We could be in Panacea. We could be in World War III. So I think you need to be to run your business very down to earth, practically, conservatively, and I would caution that even though the market seems to be opening up and there seems to be more investments happening, in terms of size of investment now, I think the market is very selective, and so time actually is a great way to bake a business. And if you can buy time and not have to dilute, I think you're in a much better position. So our view at this point is not to be wild with funds. Conserve the money, make practical decisions. Test, see the result. Build. Revenue is the cheapest form of equity. And so, our view is very much along those lines.
Excellent. And, recently we've had a report that comes out that says Australia is one of the most efficient VC capital ecosystems out there, and that's great. But we've also had reports that paint a stark reality about raising a second fund for first-time fund managers. And the number that jumped out to me was around 28% of first-time funds in Australia will not be able to raise that second fund. And I'd really love to hear what's your advice for building maybe a differentiated fund in this environment. And if you want to maybe touch on some aspects of LP relationships and navigating fundraising yourself, it's probably our number one topic that we heard from folks that they'd like to hear about.
So what percentage did you say that wouldn't raise?
A pretty high number. It's a 28% in a report that was 4 or 5 months ago.
So I actually think that the number is even higher. Not maybe in Australia it's 28%, but I think when you look at the US, Europe, I reckon it's probably 45% won't raise another fund. I think that what happened was that a lot of emerging managers came about on the basis of, hey, I worked for Uber and so I'm a genius and now I'm going to start a fund. Or I worked for Monzo, I worked for Canva, so now I'm going to start a fund. And actually, there's a big difference between being an employee at Canva or one of those businesses and having the experience to understand how business works. And a lot of these emerging managers built their business on the basis of, I know these people, like access to networks, access to other people, and saying, I can put a small check and hopefully get a great return. But unfortunately, for them, business is far more execution based. You've got to work with the founder, not pander to them. You've got to build a business, not hyper business, and that takes time. And I think what happened is a lot of these emerging managers raised at the time when the market was in this full on bubble. And what's happened subsequently is a lot of businesses didn't make it. A lot of founders have found that they walked away from those businesses because things were hard and they didn't expect them to be hard. Because, when you have your free flat whites and laundry done and things like that at the big Uber or someone like that, and then suddenly you go off, raise money, and you try to offer the same thing, pay high salaries, and you don't get to the market because the market has changed. Many of those folks regret it and go back. So my sense is that and ultimately LPs will give you the benefit of the doubt typically on your first fund in order to raise a second fund. But coupled with the fact that LPs have less money and have got a lot of choice, and they're going to look at things like DPI before they look at other measures. And unfortunately, if you don't have DPI and you don't have other real measurable results, which is kind of, for example, a high IRR or a high markup in like the top 1 or 2% of startups out there, I think it's going to be a real battle to raise money.
Yeah, I would say from our members, it's definitely being described as a battle. And I'll have a couple more questions to close out before we go to the audience. But one that's just been on my head is, what is maybe the best investment decision that you've ever made? Maybe it's one that you haven't made. Maybe it's one that you've declined a deal, or what's and then conversely, what's the best personal decision you've ever made?
So I can't, I won't give you a best decision I made on a business, because all of my portfolio company are my children, so I don't want to pick a favorite. But a few things that happened, turning points, I suppose. One is where at Monday.com, we had written a small check as part of the seed round, and 15 months later, they had 5-6 months of money left, and everyone left the table and walked away. And I really understood what they were trying to pivot into and build, where everyone else had kind of gone home frustrated. And it came to a critical meeting where I literally pounded on the table and I said, I'll give you another $1 million, where no one else would. And that was like the key turning point in that business, because I made friends for life with that decision. It also ended up being a unbelievably great return on investment. And I think that was kind of, one great opportunity that happened. Other decisions, along the way is, I would say that it was a great decision, a personal decision to move to Israel when we did. We had lived in London, but the weather was bad, and South Africa, there was a big challenge with Black economic empowerment, where it was just impossible to do business. Everything was bribery and corruption. Personal safety was a challenge. And one would say, why would you trade one big risk to another big risk by moving to Israel? I think that the one thing about Israel is that you believe in something. The entire nation believes in something. You have an unbelievable way to for your children to grow up, where in many Western countries they are very much whisked to the side by shopping malls and things like that, and TikTok and stuff like that. Not to say that Israel doesn't have shopping malls and TikTok, but there's some sort of reality, practicality that comes with with serving your country. It kind of matures people very quickly, and there's nothing wrong with standing up for something you believe in. So I think kind of personally, it shaped us a lot, and also for my kids. So that's a key personal decision that was positive, I suppose.
Yeah, I'd agree. When I moved to Australia 3 years ago, I was quite hesitant on the idea, and I think it's one of my best decisions I've made as well. So yeah, it's always lovely to into a new environment, and it kind of shapes and grows you, almost like building muscles. So thank you, Avi. I would like to offer a chance to anyone here in person here in the group to come up and ask any questions. Does anybody have anything on their mind they'd like to ask Avi? Howard? No? No? Okay. Let's also turn to the folks virtually. Is there any folks that want to jump in virtually that have any questions that have been on your mind? Feel free to just turn your camera on, and I'll pin it up onto the board, and you can go ahead and ask your question. If not, I have more that I can ask. Oh, yeah, Hendrik, come on up. Yeah, come on.
Sorry, just volunteering here if nobody else wants to. Hi, I'm Hendrik, emerging manager. So I'm on my personal first fund, but the firm is on kind of the second fund. Yeah, with the kind of emerging managers dying all over the place, what's your kind of advice that you would give if you were like starting out again?
If I was starting out again, I would try and set myself apart from the other emerging managers. I think that the general view of a lot of emerging managers is that they're really good at hustling to get business, but very much focused on the decision is on the network and the founders that they find. Where I think that emerging managers that will be successful are the ones that can actually make fewer investments and work harder on the investments and show that they can add value consistently and build a reputation like that. So fewer deals, more focus on delivering the value that to make the assets successful. So you're associated with that success, and then kind of practically to set yourself apart from a lot of folks who do relationship investing.
Right. Thank you.
Anybody else in the room? All right, great. And we kind of spoke a little bit about hype, and I wanted to kind of touch on an aspect that we were talking about with our friends at Google today. But one of the presenters was saying that his opinion on some AI products and the AI that's offered into the world of startups, maybe a little bit, the word skeptical was used, and we do have a risk of believing hype and making bets on that hype. What is some other risks out there that you see in terms of this AI introduction into investments and decisions? Is there anything that you folks tend to make sure to pay attention to when you're making those decisions on AI products or AI startups?
So, there's a real FOMO in the market. Everyone thinks that if they don't make the AI investment or don't have a horse in the race, that they'll lose out. I think that there's a lot of false positives in the AI world at the moment in terms of startups. A lot of startups are scaling because they're getting some sort of level of virality, but their churn is just incredibly high. I mean, we've seen businesses that are kind of getting to 10, 15 million of revenue inside of a year or two, but have 80% churn. And it's just not sustainable. It's just kind of using investor money and disappearing after time. And I think part of it has also got to do with you can't just take OpenAI or Gemini, slap on an interface, and you've got an AI tool. There's a lot of stuff missing. There's a lot of inference on the model that's missing. There's a lot of hallucinations happening in the models. And so I think that the real emerging winners will be the ones that can really build a layer between the AI and the user interface that learns and understands what it can rely on the AI for and how to avoid hallucinations, and builds I would call it like a middleware LLM that kind of is a filter for many of the answers and adds a lot of value around it. So I think that, and I think that folks are getting carried away by the foundation models being the OpenAI, Anthropic, Mistral, etc. I think the challenge there is that it's a race to the bottom, because the tokens will be offered at really, you can really see that the price of a token is 1/100th of what it was a year ago, and it will just be a game that only the big players end up being able to offer, and yet they've taken in so much money. So and a lot of the money that they're taking is supported by the existing business model, if you're Microsoft or Gemini, for Alphabet, etc. And it's kind of challenging for OpenAI then to figure out where does it end up, because it's in a race to the bottom where it doesn't have a way of subsidizing what it does, whereas Microsoft and Google and others do, and Meta. So I think we haven't seen the end of that, but I think that by the same token, a lot of the everyone is going to give you multiple opportunities in multiple agents, as a business, and there will be a plethora of agents, all over the place doing the same thing. The question will eventually become who is the best at offering something for a very niche vertical, because you can't be everything to everyone. The models are too wide. The amount of education learning you have to do specifically for a job function or some sort of workflow that you want to do is very specific and takes a long time. I also think that a lot of corporate budgets are right now just tiptoeing and trying out things, but if you look at Fortune 1000 companies, etc., they're not going all in yet. And so a lot of the things that you're seeing in startups is false positives. And they'll be, my fear is that many will burn on the way to educating the big spenders, the big corporates, at which point the big corporates will be educated and there'll be a second set of more evolved startups that will come along and win that business long term. So I think we're only at the beginning, just kind of like any hype cycle. So you need to make bets. I think you need to make bets which are vertical, which are niche, which have long-term viability, and where you can build a moat. And that moat is not distribution or something like that. That moat is actually a quality product with quality deliverables. So my view is get very focused and win a very thin, tight category, then try to build something that applies to everyone and everything.
Yeah, I agree. I'd like to just end with one kind of more introspective question, which is, us preparing for our eventual retreat out in Western Australia in August. We took about 60, 70 interviews with VCs in our community and throughout the world. And about the 70 of those interviews, probably there was 42 or 43 top things that they were worried about, or that they were more concerned about or more interested in. And so after a little bit of time, we decided what that meant to us was that there was a lot of noise. And that idea of so much noise and so much information and data coming out of VC can have some negative effects. Just bad decisions are made, unintended consequences occur, and even more likely, the inability to make decisions because of all that noise. Will this work? Will AI eat this product in 6 months? Will this team be able to handle the changes in the market in a year or two from now on? It's a lot of information coming at VCs. Do you have any maybe advice for how they can handle all that noise?
Yeah, so my view is to be contrarian. So I think that where you build real success is not by deferring to the average, the common view. I think that you build your real winners because you go to the outliers, because you make the decisions that are tough, you make the decisions that are not the run-of-the-mill that everyone else is going for. So I think that the best advice is find something that you have absolute conviction in, regardless of what the market is saying. And chances are that you'll find your big winner there.
Excellent. Yeah, focus on the principles and and maybe ignore that noise. Well, thank you, Avi. I really appreciate you joining us today, and thanks everybody from the Aurora community, as well as any folks here in the room with us at Google. This is one of our first Global VC virtual series events, but Avi, it's really a great pleasure to speak with you, and hopefully we can welcome you to Australia in the future. And if you do, please let me know. We'd love to host you for a dinner with the community. And again, thank you so much, everyone, for joining us today, and best of luck in the future for everyone.
Thank you. Really appreciate the opportunity, and good luck to everyone.
You as well. Thank you.
Bye-bye.